Welcome back. Now, have you ever wondered why the rich keep getting richer, even in troubled times? Wonder no more. Hedge fund managers essentially use some of the tools of modern finance when investing in order to protect themselves from market risks that they wouldn't like in their portfolios. So, as markets become more volatile and spend more days down than up, today on Investments 101, we focus on investing at a time of great volatility, looking at hedge funds. Hedge funds are often hailed as moneymakers during boom times, facing much scrutiny in times of crisis. But proponents say not all hedge funds are risky.
So not all hedge funds have got the same risk profile. You get high-risk hedge funds and low-risk hedge funds. All the major hedge fund players in South Africa are closer to the lower risk profile, where through going long and short shares, you decrease volatility, and it is usually less risky than just buying shares without the shorting component.
Shorting means you borrow shares from someone, then you sell them onto the market, and you make a profit when the share price actually falls. After the expected fall, you buy back the shares and return them to the lender, and you pocket the profits. Up until now, hedge funds have been the playground of South Africa's wealthy. That's because in order to invest in hedge funds here, you need a minimum of 1 million rand in assets. But that's about to change.
Legislation and regulation is on the way with regards to hedge funds, especially with regards to the investment strategies and vehicles and how these services are offered to the general public. That's what the industry is anticipating and expecting to be relatively imminent. So with that as background, we do think with that coming through, it should be much easier for the broader public to invest in hedge funds.
But is the average South African investor financially savvy enough to take part?
Given the somewhat complex nature of the investments, it does require some investor understanding in the product. And it also, given some investment minimums, which tend to be quite high, it's also seemingly quite exclusive to the high net worth individual.
Hedge fund firms like ours probably need to do a better job in educating people about what hedge funds do, and financial advisors need to read up as well and make sure that they understand it so that they can advise their clients about hedge funds, the risk profiles, the return expectations, and the product as a whole.
Hedge funds generally make better returns than conventional investment vehicles like unit trusts or equity funds when markets are falling. But the hedge fund manager needs to know exactly what he's doing.
So we have seen in the last month or so, as the markets have fallen quite sharply, hedge funds have fallen less. Still a slight negative return though. I think it's an important point to make that hedge funds can't guarantee that you will not lose any money. But over the long term, your return should be less volatile than pure equity investment.
But as always, buyers beware and consult your financial advisor before making any investment decision. Well, it's been a bit of a roller coaster ride on the markets this month as things look quite dicey globally. We've seen a bit of a recovery in recent sessions, but some believe the correction on the market may not be fully done yet. So, as an investor, what to do with your investments in times of market turbulence, and are hedge funds the place to go? What other options are there? We're joined now by Leven Gopal, who's a senior trader. Leven, thanks for your time this evening. Hedge funds have had a bad rap in the past, particularly during the economic crises of the 2000s and, of course, the tech bubble as well. Why do they have such a bad rap?
So, in general, the hedge fund investment is for a very sophisticated investor. It is complex, and because of some of the legislation regarding knowledge of the consumer, being aware of the product, being aware of the risk, it has attracted some very high net worth individuals. It hasn't been something that you'd look to as an investment for the average man. One, because of the high level of entry, but two, because of the level of sophistication. In simple terms, a hedge fund is a tool which can take advantage of either highs or lows in markets. If markets are going up, they can make money. If markets are falling, they can make money. And they use a variety of sophisticated tools. It's not very complex to wrap your head around. It is just another form of investment, but unfortunately, the barriers of entry have been difficult. It's also not been highly regulated in South Africa. You've had a few cowboys. So because of that, you would have seen some of these hedge funds blow up during violent swings in the market.
All right, but it's not the only option, right, when markets are down. So let's look at what are the more viable options for people who don't have R1 million in assets to put on the table.
So some of the traditional investment models that are available for the average man have proven to be very successful. The obvious vehicle, many of your viewers would be aware of unit trusts. Unit trusts is a collective investment scheme. This is a collection of various funds from you, me, and general public. They put in 500 Rand a month or 1,000 Rand a month into a particular investment vehicle. Those monies are then applied to the market, and a portfolio of good shares are purchased. So there's more than 1,000 different unit trust companies to choose from. They have various returns, and some of them specialize. They focus in certain sectors. It is a viable option because the costs are in the order of 2%, so they're not very punitive from that perspective, but it is very good in terms of spreading out your risk. So that's one of the important choices. Another choice that you could look at is the Satrix 40, and there are now a number of other exchange traded funds that have become available. The Satrix is a good vehicle. All that does is it tracks the top 40 shares, and over a period of time the markets continue to grow. So you have little falls, you have pullbacks like we've seen now for more than 10% in the last few weeks, but over a period of time the markets continue to swell. And a good case in point is around 2000 our market was worth 10,000 points. Fast forward to 12, 13 years later, and the market's almost 50,000 points. So if you had bought the Satrix, you would see that measure of growth.
If you had stayed.
You had to have stayed. And so one of the big elements about investing, about being in finance, is the time factor. And if you are able to start at an early stage and continue to plow in the money, then you will reap the rewards. So it is about spending considerable time and riding through the dips. And
what about bonds? I mean, I get asked this quite a lot. A lot of people, particularly with the popularity now of the RSA government bonds.
Sure. So bonds have changed their popularity in South Africa. There was a time during World War II, during the early years of finance in South Africa, where bonds were a very popular instrument. Bonus bonds were popular in the 60s and 70s, and it was a means for people to save. Bonds will pay an interest rate to the investor, and during this time where interest rates are low, it hasn't proven very attractive as a vehicle. Now, say retail savings bonds are very good stay away or stash of money. Your money's going to be safe. You're lending it to the government. They're considered to be the best and safest place to be. But the return is not as glamorous as stocks.
All right, we'll leave it there. Thanks for your time today. Senior trader Levin Gopal. Our daily question and answer feature is up next. Stay with us.